Why are so many Americans feeling uneasy about the economy right now? Even as inflation cools and interest rates are finally coming down, consumer confidence across the United States is quietly slipping. At the same time, the Federal Reserve has cut interest rates again, signaling a major shift in monetary policy. These two developments are deeply connected, and together, they raise an important question. Are we heading toward an economic slowdown? Or is this the calm before a recovery? Consumer confidence is essentially a measure of how optimistic or pessimistic people feel about their financial future. When confidence falls, people spend less, delay major purchases, and become more cautious with money. Right now, many households are feeling squeezed. Prices for essentials like housing, groceries, insurance, and healthcare remain stubbornly high. Even though inflation numbers look better on paper, wages have not fully kept pace with the cost of living, and for many Americans, credit card balances are rising while savings are shrinking. Adding to that anxiety is uncertainty in the job market. While unemployment remains relatively low, hiring has slowed, layoffs are making headlines, and workers are increasingly worried about job security. When people are unsure about their income tomorrow, they naturally pull back today. This drop in spending power is one of the biggest warning signs. Economists watch closely because consumer spending drives nearly 70% of the U.S. economy. Against this backdrop, the Federal Reserve has decided to cut interest rates again. After aggressively raising rates to fight inflation, policymakers are now easing monetary policy. The reason is simple: higher interest rates slow down borrowing and spending. That helped cool inflation, but it also increased the risk of slowing economic growth too much. By cutting rates, the Fed is trying to strike a balance, keeping inflation under control while preventing the economy from stalling. So what does a rate cut actually mean for everyday Americans? Lower interest rates make borrowing cheaper. That can translate into lower monthly payments for adjustable rate mortgages, personal loans, auto loans, and business credit. For people already in debt, this can provide some relief. For businesses, cheaper borrowing can encourage investment, expansion, and hiring, which is exactly what the Fed hopes will happen. However, there is another side to the story. Rate cuts often signal concern. The Fed usually eases policy when it sees signs of economic weakness ahead. Slowing consumer confidence is one of those signs. In other words, while lower rates can help support the economy, they also suggest that policymakers are worried about what comes next. The stock market typically reacts quickly to interest rate cuts. Lower rates tend to boost stock prices because borrowing becomes cheaper for companies, and future earnings look more attractive when discounted at lower rates. That's why investors often cheer rate cuts in the short term, but long-term investors know that not all rate cuts are equal. If rates are falling because the economy is weakening, corporate profits may eventually come under pressure. For savers, rate cuts can be frustrating. Yields on savings accounts, money market funds, and CDs often decline when rates fall. This pushes many investors to take more risk in search of returns, which can inflate asset prices and increase volatility. It is another reason why economic transitions like this tend to create winners and losers at the same time. Now, let's connect the dots. Falling consumer confidence suggests households are becoming cautious. The Fed cutting rates suggests policymakers are trying to prevent that caution from turning into a full slowdown. Together, these signals point to an economy at a crossroads. The next few months will depend heavily on how consumers respond. If people regain confidence and start spending again, rate cuts could help fuel a soft landing. If fear continues to dominate, even lower rates may not be enough to spark growth for individuals. This is a moment to be strategic, managing debt, building emergency savings, and avoiding unnecessary financial risk matters more than ever for investors. Understanding the broader economic cycle is key. Markets may rise, but volatility is likely to remain elevated as new data reshapes expectations. The truth is, economic slowdowns rarely arrive with a single dramatic event. They creep in through shifting behavior, cautious spending, and subtle policy changes, exactly what we're seeing now. Whether this turns into a mild slowdown or a renewed expansion will depend on confidence, policy decisions, and global economic conditions. If you want to stay ahead of these shifts and understand what they mean for your money, make sure to subscribe to the channel. We break down complex economic trends into clear, actionable insights so you can make smarter financial decisions in uncertain times. Thanks for watching, and I'll see you in the next video.